Hi, everybody. Thanks for coming again. My name is Eng Taing, CEO and founder of Cozy Capital, and I'm excited to share this um, this presentation on how to leverage your RSUs to invest in real estate. I think for a lot of you guys in this audience, you guys know what RSUs are, but it doesn't necessarily have to be RSUs. It just has to be, which RSUs are restricted stock units, but it has to be equities. How to leverage equities to invest in real estate. And also doesn't have to be invest in real estate. But I wanted to highlight this specific phrasing because I think this is a common potential scenario that many of you guys might be facing. This is going to be a rather short presentation deck. I want it to be as interactive, so feel free to ask as many questions as possible. Um, my name is Eng Taing. I have a background in economics and finance for those who haven't seen this slide. And I've was most recently at Apple, but now I've run and lead Cozy Capital, where we have more than 140 millions of assets under management, mostly in real estate and some in Bitcoin. And Shiv?
Hey everyone, good afternoon. And first of all, thank you, Eng, for giving me yet another opportunity to moderate today's session. So I will be the moderator for this evening. I am a very active investor, not just in public equities, but in commercial real estate and alternate investments as well. But before doing that, I had 20 years of an amazing time in the high-tech industry. I started my career in a startup in Mindtree, which eventually went public in 2007. And after another stint at a startup called Modulus Video, I found myself at Facebook, had a wonderful time at Facebook. And in 2019, I said, had a good time at tech. It's time to start focusing on my investments and my other interests. And that's when I bid goodbye to the tech industry. And since I've met Eng, it's been lovely being together with him for the last 1.5 to 2 years. We've had very, very engaging discussions. I'm getting closer and closer to understanding how Cozy Capital works. But I also actively invest in Cozy Capital leads, but today my role is that of a moderator to guide the questions that you have towards Eng and make sure that your questions are answered. Back to you.
Thanks, Shiv. I want to start this presentation really talking about leverage because the underlying strategy here is leverage. And it's a strategy that real estate investors use all the time. I think there are a lot of benefits to leverage if done correctly. And the first one, and for those, many of you guys who I've talked to personally, I always try to tell you guys to know your options and optimize your capital. When you know your options to deploy capital more effectively and efficiently, you can allocate capital well and you can optimize your capital, which means to get as highest risk-adjusted yields as possible. For real estate, a lot of times that means using leverage to get outsized returns relative to given cap rates. A real estate investment could have a 6 cap, and if you weren't using leverage, you get 6% returns every year. Now that doesn't sound like a lot of returns, but when you leverage it and you lever it at 75% and at a low interest rate, that's how real estate have generally outperformed stock indices over the last 50 years. The power of leverage. And it's also a very tax efficient utilization strategy. For many years, I have been taking out cash from my real estate investments. I think of them as bank accounts. I get cash flow from them. It's a really great bank account. And I can do cash out refinance when equity goes up or when I pay down my debt lower, oftentimes both. Or I can do a HELOC. These are really great tax efficient strategies because I don't have to pay taxes on those borrowing. And a lot of companies do this now. If you raise a capital gains rate or you raise this rate taxes, most people would just borrow against it. And that's how you get liquidity out from illiquid assets. And real estate is prime amongst them, but there's lots of different ways to, lots of different assets classes that are liquid, but you will rather have long term. And so using leverage is a really great way to maximize your potential earnings. And for today's topic, I really want to focus on securities line of credit. And if you, the best way to think about it is sort of similar to a HELOC, but really what it is about borrowing against your portfolio. And for folks who are my former fellow Apple employees, borrowing against your vested RSUs or just anything in your E-Trade account or any any equities. And generally you get around 65% LTV there, up to 60% borrow rate. And you can borrow against it to then utilize for other investments. And the general rule of thumb is also the more you borrow, the lower the rate. Shiv, you tried to actually did an example and try and borrowing it earlier today, right?
Yeah. So, I mean, I guess most people would have a brokerage account, maybe Charles Schwab, E-Trade, whatever it is. So I think if I went into my E-Trade and said, here is $1 million of my equity, and I want to use that as a collateral, I could probably get a 2.625 to 2.7 for that. That's what we are talking about in terms of overall, because what you're showing here is the fixed spread plus LIBOR. Mm-hmm. I was saying I could get a 2.7, 2.675 or 2.7 today for that, for the 1 million. That's true.
And when you can borrow against your assets and you want to keep those assets and borrowing at a relatively safe margin level, it actually makes a lot of sense then to use it to arbitrage. So who is this for? It's more attractive when you have large equity portfolios because you can have lower rates, but that's not always the case. You can always borrow at lower volume amounts, but just the rates are a bit less attractive. Investors who have long-term portfolios. Shiv, you probably have lots of equities that you love, that you don't want to exit out of, that you have long-term belief in growth of, but you're probably not getting cash flow from them. Maybe they're providing a little bit of dividends, but they're not providing you the income that you could be getting. And you have lots of unrealized capital gains, and you've invested in a few OZs, but you don't want to invest all of it into OZs and lock yourself into a 10-year holding, because you want to continue to own these equities positions. This is who it's for. It gives you a little bit of flexibility. It gives you more capital to then deploy into potentially real estate. Mm-hmm. And especially for those who are long-term holders of your stock positions, but not really, but you're not really seeing as immediate advantage now in terms of cash flow, and there's also obviously you have lots of unrealized gains. So when you borrow against it, you don't really have to pay taxes on it.
Mm-hmm. Awesome. Just one quick question has come in, Eng. When we said approximately 65%, is that just for the vested RSUs, or does it also include the unvested RSUs?
Typically includes only vested. Oh. I haven't seen unvested be included. I think when you're looking at, because that's not actually yours until it's vested.
I tend to agree with you. What's not vested is not typically something that you can leverage on. I agree with that. There's one more question, probably we can take care of that. An attendee is asking, I see mention of vested RSUs in the invite and in this presentation. How about when I have shares that are a result of exercising vested ISOs?
Jeff, you want to take that?
Yeah, so let's be very clear about ISOs, right? If you have ISOs and if you have vested ISOs, if you've exercised them, there is already a tax burden on you when you're exercising ISOs. If you've not exercised the option, typically the brokerage is not going to consider that as your asset. Because tomorrow you can just walk away from that saying, I don't want to exercise that option. Because in further slides, Eng will talk to you about how this equities, vested RSUs or whatever it is, equity is being used as a collateral. So a vested ISO that has not been exercised typically would not be considered as a candidate for an SBLOC, typically.
It's true.
There are a couple of questions more. To all the attendees, especially people who are attending for the first time, if I'm not bringing your question up to Eng, it's because maybe that question is automatically answered in a slide down the line. So just please be patient with us. We'll make sure all questions are answered. Eng, you should continue because there are ifs and buts questions coming. So, but go ahead.
Yeah, and this is a long deck, but there's lots of great information here. And I want to really highlight who's this useful for, because it's usually typically short-term lending, useful for emergency funds, short-term coverage needs, bridge funding for specific projects if you're a real estate investor or investor, and leverage into cash flowing real estate. And I think real estate is a great asset class to then leverage into, meaning to borrow 65% of your equity position and then invest into real estate, because typically real estate is it generally has a forward momentum and cash flowing, and so it's a relatively safer bet. Obviously, that's why with oftentimes less volatility. It is not useful for long-term financing because you usually can't get long terms for it, and it's not. I would not advise it as a high-risk investment, meaning to invest into other highly leveraged options like margin trading or invest into even cryptocurrency, which anything that has high volatility.
Yeah, and if I might just add, most of the brokerages, when they give you an SBLOC or the banks, they will not allow you to use that money for margin trading or option trading. So it's out of the picture. It's clearly written out there saying you cannot do that. So it's good for you.
Yeah, they have restrictions on it. Yeah.
Yeah, and what they do explicitly mention is, of course, you can use it for things like real estate investing, as long as you know where you're putting your money and it's not another one of those crazy entries. Quick question from an attendee: will the recording be sent out? Absolutely. As always, we will share the recording immediately after the webinar, maybe a couple of hours, as our staff will be editing the video and just sending it out. Carry on.
So, as I said before, there are typically 2 to 5 year terms. The rates are usually fixed rate plus LIBOR. Now, I'll highlight in the slide how to LIBOR rates are. They're offered by TD Bank, for example, regional banks. Interactive broker is another option. They usually use it for leverage trading. But I have an investor I talked to today who shared me with this screenshot where they borrowed 25% margin against their Apple shares at 1.15% rate. So it was, relatively low rate with using the pro account. So feel free to check all these options out. Of course, you can always borrow with your E-Trade account as well. And this is sort of an example of interest rates at one of these banks. I'm not advocating for any of these solutions, just highlighting options. And one thing you want to highlight is the more you borrow, the lower the rates are, which is generally true for lots of different things, including real estate.
Eng, a lot of people are asking questions on things that we haven't covered. What happens if the stock price goes down and so on? Just wanted to let the attendees know we haven't covered that yet. So we're going to talk about the risks and how it's managed, what's the collateral, so on. Go for it, Eng.
So rule of thumb, more you borrow, the lower the rate. And LIBOR rates, so for people who don't know, LIBOR rates have been trending down over time. And that's been good for real estate investors like myself, and that you can leverage that for your own investment. So LIBOR rates are close to zero right now, which means that you can get a mid 2% rate as the firm's adding that 2.5 points on top of LIBOR.
Eng, so if I just look at the slide, so let's say based on this information, tomorrow I go to my brokerage and this is an answer to what one of the attendees is asking. You should either go to your brokerage or to one of the investment banks which allow SBLOCs, and they are the ones who will clearly tell you, see, it's not just about RSUs, it's what RSUs you hold. I have to say this, an Apple RSU or an Amazon RSU makes these investment banks, their eyes light up, as opposed to, I shouldn't say this, but a more obscure company, right? Because that's what gives them the comfort and the collateral. So they will be able to tell you how much you'd be able to lend. But what I wanted to share is basically, and if I just go tomorrow to E-Trade and say, this is what I hold, and E-Trade tells me it's LIBOR plus 2.5, if that's what they are telling me. So I have to go look up somewhere what's the current LIBOR rate. You're saying it's 0.17, or it might be slightly different now, and add it to their spread. And that's the interest rate I would be paying on that line of credit. Is that correct?
Yes, typically.
Okay, so please go check LIBOR rate, ask for the spread, and ask for any hidden fees. And that's typically what you have to pay as interest. And it keeps changing monthly, but it's a daily, but it's charged on a monthly basis.
Yeah, and you're right, Chip. You know, an Apple stock is blue chip stock.
Yeah.
It's, you know, it's relatively stable. Obviously, any stock could go down 25, 30%. Yeah, in given situations, but the general reference people talk about when talking about Apple stock, for example, is that it's a easy to borrow stock, and it's hard to borrow stocks. They're usually more volatile, smaller. For example, Snapchat is relatively harder to borrow stock, even though it's a pretty big company, big public company, but relative to Apple. So you can typically see potentially higher interest rates, as well as lower margin, lower leverage options. So what are the disadvantages? So when used to purchase real estate, the interest isn't tax deductible. And when I invest and I borrow money from real estate, I can get that. And all my loans on commercial real estate and any income producing real estate, or even my personal real estate up to a certain level, that interest is tax deductible. So unfortunately, when you borrow on your securities, that interest that you pay, that 2.5% or whatever it is, it's not tax deductible. There are risks of collateral costs and liquidation. So obviously, when prices go down, that means you're under collateralized, and the banks have first penalty on the collateral. So don't risk what you can't risk. But of course, you know, given the market going down 25% and you leveraging 65%, you do risk a collateral call and liquidation event on your equities. So that basically the bank or whoever's lending it to you can liquidate and then fulfill their loan position, and that's pretty immediate. So you obviously be tracking that. They can demand loan potential loan call at any time. These are really popular before the Great Depression, but less so now. But generally nowadays they have been getting a little more popular. But a lot of people use leverage on stocks nowadays with all kinds of different kinds of derivatives and strategies like margin trading and whatnot. But this is specifically, I think, useful for investing into real estate.
And a couple of questions have come in. Let me see if I can order this. I think people still want a more clearer definition of LIBOR. I mean, you and me constantly use that every day because we are in commercial real estate. So maybe a little bit of definition on LIBOR would help. Can I take a first stab at it and then you can follow it up?
Sure.
Yeah, so LIBOR by definition it stands for London Interbank Offering Rate. This is the rate or the percentage rate, the basis point rate that banks use to lend money to each other. So when we are talking these kinds of loans or lines of credit, they are not fixed rates. So the LIBOR rate itself, the rates at which banks lend money to each other, keeps changing. So in order for the brokerages not to give you a rate where they'll completely lose money, they will always say the LIBOR rate plus a small spread is what happens. And LIBOR rate keeps fluctuating. That's where when you say a Fed makes an announcement on interest rates and so on, you'll see the LIBOR rate, the rate at which banks lend each other, this keeps fluctuating. But for all practical purposes, the way the economies have been run in the last few years, LIBOR rates are pretty low. So that is LIBOR, the rate at which banks lend money to each other. And on top of that, there is a spread. And please add more practical definitions to it if I missed anything.
That's exactly right.
I think we answered the questions about LIBOR. A couple of questions, right? I think this disadvantages section is important. What is the impact if the stock portfolio drops, right? It's a very fair question. What happens if my portfolio drops?
It's a fair question, and it's a question I would like to sort of illustrate relative to real estate, because when your portfolio drops, everyone can see it. It's a highly liquid asset. It's liquidable, so you can actually sell it, and there's a value to it. So if you have $1 million portfolio, you borrow $650,000 against it. It drops to a certain amount, and usually it's not 650,000. Usually it's a little bit more than 650,000. Let's say it drops to 750,000. The bank will start liquidating your collateral, which is the equities that $1 million of equities, so that it can secure against that $650,000 of loan that you took out. And so when it drops to a certain level, and it's typically not one-to-one, it's, it usually thinks of as uncollateralization rate. And then then you're basically left with no securities, but that loan, which is now not a loan, it's sort of a cash liquidation that you took out, potentially at a time that you didn't want to happen. Relative to real estate, though, when, maybe another advantage for real estate is that when house prices go down or up, these things aren't very liquid, meaning that there's no market for it. Yes, someone could say this house went down 25, 30%. But as long as you're paying the note on it, they're not going to liquidate it and force you to then pay the loan. Because these things aren't as transparent as well as aren't as liquid.
Thanks. Just wanted to confirm a question the attendee is asking. The rate is listed as LIBOR plus a fixed percentage. Does that mean your interest payment changes daily? As I mentioned, the interest calculation changes daily because LIBOR rates can change, although not that dramatically. But you just have to pay on a monthly basis the interest. You don't have to pay every day, but the interest does fluctuate daily. That is true.
Yeah.
Go ahead, Eng.
Although there are sometimes fixed terms for them, but yes, they do fluctuate. In real estate, we usually use fixed term rates, but the less you fix, the more you're sort of paying. You're paying for security of risks of de-risking. With these, because they're usually 2 to 5 years, the risk isn't generally there for increase or decrease in interest rates. It's today's economic condition. The Fed is going to try to keep the interest rate as low as possible.
One more question. What happens when the equity market value goes down and already an SBLOC was taken on the security before the equity going down? Does the lender have the option to call the loan back?
Yes, they have the option to call the loan back. They have the option to call the loan back at any given time. They generally don't want to. They generally want to make money. They're getting that 2.5%. They have an asset that they are probably invested in themselves, meaning Apple stock or whatever shares. So they're collateralizing and using your collateral to essentially give you money from your value money. But yes, investors, I mean, a bank can call anytime.
And typically, the actual way it happens is as the value of the equities goes down to a particular number. See, again, think about it, right? They're only giving you a line of credit which is equal to 50 to 65% of your asset. So they have a margin to play with. So as the equity value goes down, they'll reach out to you and say, you know what, you have to present some cash or some other collateral. They will give you that option. So it's not like the SBLOCs is going to disappear immediately. So if you have some other securities you can bring in, and that's when they'll say, you know what, we're going to call the loan, or if really bad things happen, they'll even sell the equities. They have the right to do that, by the way, to sell your equities to cover for the loan. But in very stable stocks with low beta values, this is typically not something to be too worried about if you're leveraging it correctly. There are some other interesting questions. Does this apply to private company RSUs? Any way to leverage those? I don't know, Eng. I don't know the answer to the question.
It's likely going to be very hard to leverage against harder to value equities. That's generally true for anything. When you're buying and selling real estate, the harder to value, the harder to estimate its liquidity. The higher the rates you would expect. So a single family house typically has the lowest rates because it's generally very liquid, just like Apple stock. A lot of people want to buy and sell it. If you're in a private company, it's similar to buying a potentially a more alternative asset that is potentially harder to sell and trade. So you usually have higher rates. Not sure if this analogy makes sense, but keep in mind.
Yeah. So as usual, as a moderator, I have the luxury of taking the easy questions and giving the difficult ones to Eng. So Eng, do you mind looking at Mike's question when he asks, what if I'm vested, but I'm on a 10b5-1 plan? To be honest, I don't even know what that means. So I'll let you mull over that question for a second while I answer a more easier question from an attendee. I hope I understood your question correct. You ask, will bank get a share from the stock that pays dividend? I hope I sort of understood your question. If you have stock and you're taking a line of credit against that stock, the stock is a collateral for the bank or the brokerage, but you still are the owner of the stock. So any dividend, any split, or anything that happens in the stock, you still get the benefit for it. So you still get the dividend. If there's a split, you take advantage of it. The people who give you the line of credit have no business taking or putting their hand into the dividends and taking a bit of it. You get the dividend, which is actually a very, very good option. People, especially who are in Microsoft and and Apple to some extent, who have very good stock which pays dividend, you'll still continue to get the dividend, which is what I really like about this option. I hope I understood your question correct. Back to Mike's question on 10b5-1 plan.
So I believe a 10b5-1 plan, it refers to insiders of a company, and if you're and so you have potential restrictions on when you can sell and buy securities of that company that you're insider of. If you're essentially using margin or leverage SBLOCs, you do have a specific inside advantage, but I don't know. I don't think, but I don't know if it affects you because you're not taking an overt advantage in terms of price movements up and down. You're just borrowing, you said, probably a bit more confidence because you have inside information, or less confidence, but then you probably wouldn't borrow against it.
Awesome. If I can just request all attendees to ask the questions in the Q&A section and not in the chat section, because what we do is finally we take all the Q&As and see if we could package it in a FAQ section for later. So please do ask your questions in the Q&A section. One of the questions that's dangling in the chat section, Eng, is what is a demand loan? What is a demand loan? A demand loan is exactly what it is. The person lending you the money has the absolute right to ask for the loan to be paid back at any time. like this one. So that's what is a typical demand loan. Your mortgage loan for your primary residence is not a demand loan. The bank is not going to come and say, pay it all back right now. So that's what is a demand loan. Here's an interesting question, Eng. If RSU is vested, we pay upfront tax through our W-2 when it's vested, right? How are we saving tax here? What is the difference between, let's take that. How are we saving tax here is the question, right?
So if your RSUs are vested and it has not appreciated, there's no unrealized gains. So when you sell it, to get liquidity to invest in real estate or invest in whatever, or to do whatever you want with it, there's no realized capital gains, which means you have no tax. If it has appreciated, then there's there's a lot of unrealized capital gains. And if you ever sold it, you would have a big tax liability. By borrowing against it, you're essentially taking out the liquidity that's trapped in that capital appreciation as well as that overall cost basis. And when you borrow against mostly anything, it's typically a tax neutral event. You don't pay taxes on it. When I take a cash out refinance, I don't pay taxes on the cash that I take out. It's a really great way to essentially disperse capital tax-free, because that unrealized gain stays unrealized, and when you do sell it, you would have face capital gains.
Awesome, thanks. The second part of the question was, and maybe I can take a stab at it, is what's the difference between vested RSU or just buying normal stock? I'm wondering why we chose the title as vested RSUs for today's presentation. It is purely because Eng has always told me that we are here to solve problems that are there. And it is a problem that we have among our investors and our friends, that we have vested RSUs that have truly appreciated. We have a huge capital gains tax burden if we sell it, and we don't know what to do with that. We are not able to leverage that capital. So purely in terms of providing a solution for a known problem out there, which is what should I do with my vested RSUs, we made the title to talk about that. So it's more as a problem solving, but it's true for any stock. It doesn't have to be just vested RSU. Am I right in what I said, Eng?
Yep.
Here is a question. How does this compare to getting cash out of a brokerage margin account, a margin loan? What's a margin loan versus what's a SBLOC?
It's a very similar strategy. Typically, SBLOCs are longer term and more for a fixed term amount, so that I think margin lending is generally perceived as shorter. I have not direct experience in that, so I can't speak as eloquently about it.
Probably one good Google search for the person who asked the question is search for purpose loan and non-purpose loan, and that will answer your question. It's always good to leave some of it out there so that you can research it. If we have time at the end, we'll definitely talk about it. That is the essential difference between an SBLOC and margin. A person is asking, I think a couple of people are asking this question. Can the payoff be accelerated in case of stock appreciation? Can I pay it off quicker if the stock appreciates? Yes. The question is, why would you want to do it if your capital is deployed and it's making money? But yes, nobody prevents you from paying off your SBLOC quickly, but where do you get the money from? Even if your stock is appreciated, if you want to pay it back, you have to liquidate, which means you might have a capital gains, right?
I mean, it's the same reason. I think it's a good conversation, and maybe should be another conversation. Why would you pay down your mortgage if your house appreciated? Just because now your house went up 2x, and you have a $500,000 mortgage on a $2 million property now. Why would you want to pay down your mortgage if your interest rate is 2.5%? Can you get better than 2.5% returns? It's sometimes it's a very emotional thing. You might want security. You might want to not have that liability if you're thinking of it one-dimensionally. But I think it's a good question to consider how your appetite for investing is.
Awesome. Here is a very interesting and loaded question. And I think this is where we request all the attendees to pay extra attention, because these sessions are educational in nature. At no point am I or Eng asking you to say, do something saying this is a great way to do it. If you know what you're doing, if you understand what it is, this is absolute amazing leverage, but you have to be careful. And this is where the attendee is asking, if I understand you correctly, this strategy has a potential liquidation risk during a market downturn. Given where we are in the economic cycle today, read potential market correction. That's what the attendee says. How are you advising your investors to borrow against RSUs? How or what are you advising? Go for it.
I'm not advising anybody to borrow against the RSU. I'm providing a option that you guys might not know about. And there's always safe ways to borrow, depending on your risk appetite. You can borrow 25%. You would have to see a greater than 60% drop in an asset class to do that. Now, if those things are happening, lots of things are correlated and lots of things are happening that's not positive in general. But the way that I think about capital is you should always know your options, know your own risk tolerance, personal risk tolerance. I take more risks, but that's because I have generally more capital and more things happening so that I can manage that risk, and it allows me, that scale allows me to diversify. I generally don't borrow against stock myself because I don't have a big equities position. I have lots of real estate position, and I'm highly leveraged on that. But I also buy mostly for cash flowing real estate, which allows me to pay my mortgage. So I don't really look at where the money goes up and down.
And I know one-on-one in a personal conversation, you would have shared more freely, but in your position where you are, it's not right to give investment advice. But can I, because I'm an investor myself, can I just share my personal experience as well?
Yeah.
Yeah. For example, let's just assume that I have $1 million of Google stock that I got way back as part of an acquisition. Now, it's reasonable to assume that Google's stock is not going to crash by 50%, right? It's a reasonable assumption. I don't have a crystal ball. Now, if I very, very judiciously, I'm not even talking about the 50%, out of that 1 million, I take 30% as an SBLOC, right? The rates remaining where they are. I don't believe that is a crazy risk that I'm taking, because to expect Google stock to come down 70%, something very big is happening in the economy then. That's one. Second thing, I only do this when I'm absolutely clear, when I don't want to sell this stock, because I already see upside in this stock. There is growth. It's just that I want to tap into the capital. So in this kind of scenario, if you have a Microsoft stock, which is appreciated 8 times already over the last 10 years, and you're taking 30% of that as a leverage to get an SBLOC, I don't think that's really, really big risk, and it can survive a market downturn as long as you can deploy that capital in a place where it's making more money than the LIBOR plus spread, right? That is very important. You can't just take that SBLOC and go crazy and put it in an Ally Bank account getting 0.25% and wait for a year. That's not what you should be doing. I just wanted to share that to make sure that at least one of us says, this is truly possible as a strategy if you know what you're doing, right? We should not be afraid of it. An investor asks, can you pay a loan call in cash rather than selling securities? Yes, of course. If you can, absolutely. You can. Does ESPP also qualify as collateral? Yes.
Yes. Vested ESPP.
Yes. ESPP that has already been granted to you is absolutely a collateral.
Employee stock purchase plan.
Yeah.
Yes.
An attendee is asking, and maybe we should just go one slide forward, because I hate to be stuck on a disadvantaged slide for too long, right? So definitely I'll wait for, why don't you go through the slide and then I'll take the 3 other questions.
So some tips and tricks for those who are looking to do this. And especially, well, you could be using an automated platform, an E-Trade, and you could not be talking to somebody. Oftentimes, you are talking to somebody, and you can. Oftentimes, you should. And you can negotiate terms. Bring more money obviously allows you to get a bit lower rates, uh, and assume the relationship will be personal. So you get to know the banker, and it's generally the case for most things. Understand how they'll make money, incentivize, and consolidate your debt and assets under one roof if possible. There's lots of relationship pricing. I know me and Shiv have taken advantage of that for our own personal residents. Um, and and then always be careful with wording. Some banks use their own formula for things like LIBOR, but which introduces risk. And you probably careful with like, don't reveal too much on like how you're gonna leverage it. And obviously they want to see you as a creditworthy borrower. And if you're worried about capital gains, you can always cycle your equities within the collateral amount. So that you can you continue to borrow against other equities, and then pay the ones you have.
Let's hold on this slide. I think probably the most important, if you really want to get into this, I mean, all of these are important, is the fourth point, right? Be careful on the wording. And I think we should make that in bold, LIBOR-like. You might have some people come and say, it's a LIBOR-like rate. When they say LIBOR-like, all they are trying to say is it can fluctuate. But fluctuate based on what? What is it anchored on? Becomes very important. So LIBOR versus LIBOR-like is different. So you want to be careful. And a couple of interesting questions. I don't know the answer to this. If my RSUs are vested, but they are in lock-in period, company went public recently, can you still get an SB lock? I would think so. If they are your stock, I don't know the answer.
Typically, if there's a way that you can lose those stock by getting fired or quitting, typically a bank will not realize that as your asset until it's realized or vested. Typically.
Yeah, especially this question. Don't even hesitate. Talk to your people, the brokerage that you have, and ask them this question very openly. They'll know the answer. Because what happens is the bank or the brokerage always reserves the right to liquidate your position to cover for the line of credit. Now, if you're saying that you're not allowed to do that because there's a lock-in period, then the brokerage might be uncomfortable. But if that brokerage has a stock plan account with your organization, probably they understand it better. So talk to them. I personally don't know the answer, but that is I think the other question is also taken care. The quiet period question is taken care as well. Follow up on taxes for RSUs. Is there any way to avoid the income tax? I think you mean the W-2 income tax on RSUs as they vest. I don't know. Eng, do you know of any way?
I think you have to tell your company specifically you're tax exempt or change your withholding amount, and they can adjust that. Otherwise, they will liquidate close to half your unvested shares to then vest it. And now, if you do that, then you do have tax liability. So hopefully, you have other ways to then reduce your tax liability. But typically, you would have to talk to your company and to your broker as well.
Yeah, and all that Eng's saying is at the time of vesting, you won't be paying the tax, but that tax year, you still owe the tax. So come the tax year, you have to pay tax for that, and that will be considered as W-2 income. So both of us have no way, at least both of us don't know if there's any attendee or investor here who knows the answer of completely magically avoiding tax on vested RSUs. We don't know that. It'll be very good to know. I will be very thankful if you tell me how to do that. And attendee is asking, what is the normal term of these kind of SBLOC loans? You covered that in a slide earlier, right?
Yeah, so typically 2 to 5 years, and they are, this is a rate for banks. So the higher the amount you borrow, the lower. LIBOR being close to zero at this point. So not too bad of a deal.
Can we go to that tips and tricks? Because an attendee is asking, you had mentioned cycling equities as a strategy. You can always cycle your equities. So just wanted to, can you elaborate on that is what you're asking?
Yes. So the way to essentially, refrain from future capital gains rate is to realize gains within a certain amount. So if you want to essentially sell an equity position and then buy it, so I might be confusing myself on another.
I think one of the things that you had mentioned to me, Eng, is, and I think that could have been the inspiration why you wrote this, but I'll just try to jog your memory and tell me if that's what we're talking about, is let's say I have a particular equity, a set of equities that I've taken a line of credit against, but I also have some more equity that's slightly different. And just letting you know, there's a black box that's covering the presentation, but that's okay for now. So what we can do is, without actually liquidating any of the equity in order to cover for a loan or anything, we can keep shuffling in two different equities, two sets of equities to cover for the line of credit. That way we do not get hit with a capital gains tax bill. That's what we are essentially saying. You can close one line of credit using another set of equities as a collateral and move the line of credit there if this set of equities is going through some churn or going through some interesting event. That's how typically we will cycle, right?
Yeah.
There's an attendee who's asking, for these kind of loans, will it be monthly payments or do we choose the payment schedule? Basically want to know if it's going to affect the debt to income ratio. You'll typically pay it on a monthly schedule. I don't know of people who will agree to do it on a yearly schedule. And typically what happens is when you go to some of these good brokerages and you have a sizable amount of equities, it doesn't even hit your credit, right? They don't even do credit check. This is different. Am I right, Eng? It didn't hit mine, please.
It's your money. You have, they can see that you have money. They're not lending you something that you don't have a strong collateral against. That's very liquid. It's very liquid collateral. It's like saying, I could get warehouse line credit, or I could get other types of credit on cash, for example, if I had cash at a bank account. Equities is as strong as cash in many cases.
Maybe we can go to an example, Eng, and some of this could be clear. So I should just stop here and let you continue.
Actually, Shiv, why don't you talk about this example of an SBLOC to theory credit investment?
I'll give it a shot, but let me know if I'm derailing myself, just stop me and say that's wrong. So what we are looking at is a real example of what could be done. Of course, we are not asking you to do it, but this is realistically possible today. Let's say you have $1 million worth of some equity, right? And it's in a comfortable place, but it's a lot of capital gain. You don't want to sell it and so on and so forth. Typical example, $300K worth of Microsoft stock that you got a few years back, it's at $1 million. You have a 66% of that amount as capital gain, so you don't want to sell. What you could do is go to your brokerage with that $1 million of equity, Microsoft equity. I'm just taking an example because Microsoft has a very low beta and it's a very good candidate like Apple for getting an SBLOC. You could say, I just want a 50% SBLOC on this. And they would actually give you that $500,000 out of that 1 million, saying, here's your money. You can't put it in margin. You can do whatever you want with that. And we're going to charge you 2.75% interest on that. You could take it today. And if you've been following the rest of our discussion on commercial real estate, you can find a relatively safe commercial real estate deal, which has an 8% pref on it, a good multifamily deal or whatever it is. And you can deploy this 500K as your LP equity. And we'll talk about leverage and everything later. And you could go invest your money in this particular deal. And it doesn't have to be one deal. It can be 5 deals, 10 deals. It doesn't matter.
Mm-hmm.
what happens is every year, let's say the 8% pref is getting paid out, you're getting $40,000 of cash. I mean, it's very simplistic argument here, but this is just to illustrate the point. Now, if you have to pay a 2.75%, assuming that LIBOR is not going to crazily go up, and I don't think it's going to go up crazily till 2023, at least based on what the Fed has said, you would be paying $13,750 per year to service that line of credit loan. But you're getting $40,000, which means you are actually netting a positive cash flow. Otherwise, that $1 million would have just been sitting there and you would not have been able to deploy. While in the first year, you're making $26,250 out of this, that stock is still remaining a stock, and any appreciation in that stock, you're still getting credit for it. You're still going to benefit from that. So you go into a second year, you go into a third year, and typically, if you're looking at today's commercial real estate deals, they might do a cash out refinance in the third year, which means your original capital comes back and you can actually now close your SBLOC position. But you still have a position in this real estate investment. You continue to get your preferred return. And if it is a 5-year deal, this is an example I took of a 5-year deal here, you will be getting your sale proceeds or your capital event. I'm just taking a 2x equity multiple here as an example, evened out. You're going to get your capital proceeds at year 5 as well. Third year, your SBLOC was closed. You made a very good investment into a multifamily deal, 8% pref, with a 2x equity multiple, not too difficult to find nowadays. And that is what an IRR looks like. Without that SBLOC, you had no capital to invest, but you use the capital to invest in such a deal. You are now only hoping that your stock did not fall in value. It doesn't even have to increase crazily. As long as the stock doesn't fall in value, you are in a safe position. 2 risk positions, stock doesn't fall in value and LIBOR rate doesn't go up crazy. Those are your 2 risks. That's actually your 2 risks. If those 2 risks are manageable in your head, then this is an actual realizable investment that's possible. And did I make sense?
Yeah, and I think those risk positions are very important to note, because with real estate, I don't realize a loss on the valuation of it until I sell it, at which point I could be underwater. But with stocks, that is a very open and transparent public market. And if you're buying at 65% leverage, a 20 to 25% dip in stock could put you in an undercollateralized position to get liquidated. But yeah, I think 65% is on the extremes or in the high end. 25% is a little bit more relatively safe. So these are potential options to then deploy your capital in a potentially more optimized manner, because you're essentially borrowing at 2.75%, and investing at 8%, and that's on the pref rate. And for example, for our investors, we've paid the pref on all of our investments, and that's pretty easy to do. So a good investment strategy, good. And actually, I really like the strategy specifically with, and then a little bit of self-service with syndications or with TOSI investments, because we generally focus on cash flow as well as 5-year deals, which tie in very well with the terms of an SBLOC loan. Although, obviously, you can invest into your own real estate, invest in real estate in general, as long as you have potential liquidation options within that time period as well.
We are close to the top of the hour. This is probably the time. If you have any other questions, please do ask us. We'll stay back to answer questions. Otherwise, you have Eng's contact on screen. Definitely reach out to Eng. And I think this is also a moment where I'm duty bound to say what I'm saying. This was a slightly uncomfortable educational webinar for us, right? We've always believed, Eng and me, that we have to definitely put things out there. What are the possibilities? Our friends, our investors, our community should know. It doesn't mean we're asking you to do this. That's not what we're asking. But we know there are enough people out there who want this, like me, who have so much of capital gain, don't want to liquidate that stock because we still truly believe in that company, and we want to just deploy that capital sanely. For those people who have got humongous capital gains in a stock that's already well positioned, that you're not going to lose a lot of your money on it, this is a good strategy, and you should definitely read about it or talk to Eng about it.
Thanks, Shiv. Yeah, it's definitely a little bit farther afield from what we talk about in terms of real estate, and but it's all about capital optimization. And I think in real estate or in just investing, you should understand the opportunities, understand how to optimize your capital, so you can better maximize your returns as well as achieve your passive income or financial freedom goals.
Yeah, and this is where people now will ask all the ifs and buts questions, right? So the question is, can we buy stocks using SBLOCs, since you mentioned we cannot do option trading? Right?
There are better vehicles for that. You can use margin trading itself. SBLOC it allows you to pull out cash relatively easy on a margin trading. Well, I mean, so yes, you could. You could use it for many different things. In fact, if you don't tell your bank or not financial advice, not investment advice, you can do you can use it for buying both. Definitely not the best advice I ever given.
Awesome. We've got a minute left. It looks like we're done with the questions. Maybe it was just one of those out of left field sessions, right, where people still have to wrap their head around it, which is perfectly fine. Anyway, thank you so much, everyone. So many attendees stayed back the full hour. I hope it was at least useful to jog a thought, to create an interest, that inquisitiveness, that this possibility is there. That is what is the main purpose of all these presentations. I thoroughly enjoyed bringing it to you guys. And thank you so much, Eng, for having the courage to even bring it out there, right? So with that, thank you so much. And I want to hand it off to Eng for closing remarks.
Thanks, Jeff, for moderating this discussion. I always appreciate everybody attending these things. I think our greatest ability is to learn and continue to grow financially. And I hope to bring these opportunities or these educational events and moments so that you can also potentially look for yourself. Do your own research. It's not something that I am going to advocate everything that we talk about here, but it's definitely a relatable thing for those who use leverage for real estate, using leverage for equities. It's very similar. I appreciate everyone's time.
Thank you so much. And can I also make a small pitch from Tosi's side to all the attendees? How do these topics come about? The ones that we talk about in the educational webinar. These are actual problems or issues faced by our investors or people like us. So feel free to reach out to Eng or Ryan and say, we would like to have an educational webinar on a particular topic. You don't need to know the solution for that. Let's all get together and find the solution. So if you have a topic of interest that you want a solution for, just reach out to Eng, reach out to Ryan and say, can you guys host an educational webinar on this topic? Because we would love to hear it. And then it'll be super, super possible for us to get together the right people. There's one question, sorry, Eng. We are waiting to hear your multifamily deal you mentioned earlier this week.
Yes. We have more coming. We have lots of more investments. So primarily, we're going to give you guys great cash flowing, good risk-adjusted return investments, how you source your capital. Potentially, hopefully, this is one of your opportunities. I appreciate everyone attending. Thanks for everybody staying for late, and have a good night, everyone.
Good night, everyone. Thank you so much. Stay safe.
Take care. Bye.